Today we are going to discuss Iibf CCFE, that is Certification Course in Foreign Exchange Operation. 27 December 25 memory based case studies question. Actually 90% of the paper that they are currently asking is based on case study. So that's why in this entire video I am covering only case study only, and that too of the same nature which is asked in the examination. So this will help you gauge the recent pattern, how to go about solving the difficult case study. And for your knowledge, let me tell you that in our course I have added such case study unit wise in the form of PDF, also in the form of quizzes. You can go through them. So let's get started with the first question. I will request you to first try the question on your own and then see the explanation. So let's get started. The first question is like a scenario which has been presented before you. So basically this question is asking you, that beneficiary Alpha Private Limited is exporting a consignment of mangoes. So the consignment is of mangoes. To whom? To a buyer in Dubai, right? So the LC issued by the opening bank. Obviously you know it very well that opening bank issued the LC. So the LC issued by opening bank is specified a quantity of 4 metric ton. Upon shipment, Alpha Private prepared the document. The bill of lading showed the weight as 4000 kg. While the commercial invoice and packing list also reflect 4000 kg. The LC is silent on weight tolerance and prohibit partial shipment. So this the knowledge has been given to you, this information has been given to you. Now the question is, the negotiating bank received the document and notes the units of measurement differ, right? On one side it is MT, other side it is kg. So now the question is, under UCP 600, how should bank treat this presentation? Option A says that it is discrepancy because the unit of measurement must be identical to the LC. B says that it is compliant as long as the weight is mathematically identical. C says that it is discrepancy because the bank is not required to perform mathematical conversion. D says that it is compliant only if the beneficiary provide a conversion certificate. So these are the 4 options that has been given to you, right? You are measuring sugar, right? Someone asked for 1 kilogram and you have given 1000 gram. Both are the same, right? But unit has only changed. Quantity has remained the same. In our case, in our case what is happening, that LC is saying what? Letter of credit is saying 4 MT, right? Clearly you can see that LC says 4 metric ton, but the document, whatever document has been presented, document says what? So document says 4000 kg, as you can see written here. Document says 4000 kg. This is what document says. And you know it very well that 1 metric ton is equal to 1000 kg. So obviously since 1 metric ton is 1000 kg, so 4 MT will be how much? Will be 4000 kg, right? Exact matching. Now the question is, what does UCP say? What does UCP say regarding it? So under article number 14 subsection D, UCP says that document don't have to match. Document don't have to match word to word. Please note it down. Very, very important thing. As per article number 14D of the UCP, that document don't have to match word to word. They only should not conflict with each other or with the LC. Here, the bank has to check for conflict. Conflicting is not permissible, right? They should not conflict, right? So basically they only should not conflict with each other or with the LC. Now in this particular case, what bank have to do? Bank have to check for conflict. Yes, bank have to check for conflict, not identical wording. Bank did not need to check for identical wording, right? So as you can see, in this particular case there is no conflict because both means the same weight. Either you say 4 metric ton or you say 4000 kg, both means the same weight. So there is no conflict. So the presentation is fully compliant. So as per article number 14D, yes, presentation is fully compliant. So the correct answer to this question is obviously option number B. Now, please let me know if this concept is clear or not. So it is compliant as long as the weight is mathematically identical, and that is what UCP 600 article number 14D say. So please note the keyword. The keyword is that it is not to be identical but must not conflict with the data in the document, another stipulated document or on the credit. Please note it down. Now let's have the question number 2. Now this is the second part of the question. So now in this case what is happening, this Alpha Private Limited shipped 3.9 metric ton instead of 4 metric ton. So he was this particular firm was required to ship 4 metric ton, but instead of shipping 4 metric ton, they ship only 3.9 metric ton. Why? Because high quality mangoes were very sought. Now the question is, if the LC does not state a tolerance in the field 39A, would this be a discrepancy under the UCP 600 Article 30? So very good question it is. What is happening here? That exporter shipped 3.9 metric ton instead of 4 metric ton. And there is nowhere mentioned regarding the tolerance. Right? Tolerance has not been mentioned. Now the very good question is this a discrepancy? Options are no, it is not a discrepancy because 5% allowance is always permitted for all the goods. B says that yes, it is a discrepancy because mangoes are individual item and 0% tolerance apply. C says that no, provided the total drawing amount does not exceed the LC value. D says yes, because the LC prohibit partial shipment and Article 30 subsection B, tolerance does not apply when a specific quantity is stated. So this is a very good question. Now imagine this. Now imagine the same second case of the situation. Imagine like this, that someone has ordered 4 kg apple. Someone has ordered 4 kg apple, but the seller, has only 3.9 kg. Obviously, there is a shortage. There is a shortage of 0.1 kg or 100 grams. So now, does the UCP allow this? This is a very good question, right? Does UCP allow this shortage? Now the answer is, as per article number UCP 600, article number 30B, right? UCP 600, article number 30B, it gives an automatic 5% tolerance. It gives an automatic 5% tolerance for what? For quantity. But there are some conditions. UCP article number 30B, it gives 5% tolerance, right? For quantity. In terms of quantity, it gives 5% tolerance. But the condition is that, the goods are not counted in units. Goods should not be counted in units, right? Like it may be counted like 100 box, not in terms of unit. And second thing is that LC does not prohibit any tolerance, right? Now in this particular case, you can see this 4 metric ton is a bulk weight, isn't it? The 4 metric ton is a bulk weight. This is not a counted piece. First of all, try to understand. This 4 metric ton is a bulk weight. This is not a counted piece, right? Now, LC is silent on tolerance. LC is clearly silent on tolerance. LC is silent on tolerance, right? So obviously 5% tolerance will apply. 5% tolerance will apply. So if we see 4 metric ton, so the minimum allowed amount, let me write it down. Minimum allowed is how much? Minimum allowed is 4 metric ton minus 5%, right? As per the rule that just we have seen, 5% tolerance is allowed. So 4 metric ton minus 5%, that will be equivalent to 3.8 metric ton. And how much is the actual shipped? So actual shipment is how much? Actual shipment is 3.9 metric ton. Yes, documents are compliant. So the answer is option number C, right? No, this will not be a discrepancy provided the total drawing amount does not exceed the LC value. So simple trick is that MT versus KG rule. If the math matches, the document matches. अगर कैलकुलेशन सेम है तो LC compliant है. बस ऐसे याद रखिए. ठीक है. पहले देखिए पहला जो क्वेश्चन था, the first question was MT versus KG rule, right? So what we get to know that if we have to basically choose whether MT and KG both can be taken. So the rule is MT versus KG rule says that if the math matches, that means if the calculation match, if the calculation matches, right, then what happen? Document will automatically match. And the second rule we have seen, UCP 5% tolerance, right? Just now I told you that remember the formula, 5% free hai unless LC say no. If the LC is silent, 5% automatically apply for the bulk good, whether it is metric ton, liters, kg, barrels. And one more trick is that no tolerance for counted item. Very, very important. No tolerance for counted item. Like suppose they say 30 boxes. So in that case you cannot give tolerance. In terms of quantity you can give tolerance like units. like metric ton or liters, you can give tolerance of 5%. But if they say counted box like 30 box, 40 box, so no tolerance. If quantity is given with the number of pieces, number of cartoons, number of boxes, 5% tolerance is not allowed. So I hope this is crystal clear right now. So again I am repeating, see what is learning. Learning is very important because in the next examination preferably, most probably you will get same conceptual question but different format. So you should learn, you should know the concept. The first concept is that MT versus kg difference, it is allowed if mathematically same. It is supported by the UCP article number 14D. Right. Second thing is that shipping 3.9 metric ton instead of 4 metric ton. This is allowed because 5% tolerance automatically apply. And this is supported by the UCP article number 30B. Yes, 30B comes in rescue. Right. And this UCP article number 30B support this. First one was regarding 14D. Second one is 30B. And third thing is that we are talked about when tolerance is not allowed. Right. Tolerance not allowed. Friends, if you are looking for only one source where you get all the entire content of your foreign exchange, then you can check out our foreign exchange PDF course. You can see we have added folders like theory plus MCQ plus case study PDF and previous year question. If you go through previous year question paper, I have compiled all the important question paper which have throughout the year from starting from February till the end of December. Right, there are 5 to 6 previous year question paper, each consisting of 30 to 40 MCQs, and then you will see module wise quick revision PDF, case study with detailed explanation. So I have separately added a folder of case studies, and presently I have added module C and module D. Similarly, you will see theory and MCQs PDF module wise. So there are A, B, C, D and E module. So you can get the entire detail by WhatsApping me on the number seen from the last question here. 4 metric ton LC requirement, document presentation 4000 kg. It's quite compliant, right? Then 4 metric ton LC requirement, document presentation is 3.85 MT. There is a discrepant. Why? Because it exceeds 5% tolerance. And suppose I say 500 boxes and the document say 490 boxes, quietly discrepant because for individual item there is no tolerance. Now friends, this is the question regarding DOCDEX, right? So the question is, there was a dispute which involved not just the letter of credit but also a conflict regarding a risk purchase agreement. That is called RPA. So conflict regarding RPA. So the dispute was regarding the conflict regarding RPA. Now the question is, there was an update in the DOCDEX rule in the year 2015. So according to the 2015 update of the DOCDEX rule, can this specific dispute be handled through this mechanism? That is the question. Option they have given yes, no. Actually option number A say no. DOCDEX is strictly limited to dispute involving UCP 600 and documentary credit. Option number B says that, yes, the 2015 update expanded the scope to include risk purchase agreement and trade loan. C say no, because dispute involving multiple financial instruments must be settled in a court of law. And D say yes, but only if the dispute is valued at offer $1 million. Now, very good question it is. So let's break it down, very simply what this question is all about. Basically, this question revolves around DOCDEX. So what is DOCDEX? DOCDEX stands for documentary credit dispute resolution expertise. Right. Documentary credit dispute resolution expertise. So basically, DOCDEX is like a specialized doctor. Yes, this is like, a specialist doctor. Right. It only handles disputes related to LC, related to collections, right, related to demand guarantee, right. That was the old rule. So again I'm repeating, earlier DOCDEX was like a specialist doctor, so it only handled dispute related to LC, collection, demand guarantee. So that was the old rule. But what happened in the year 2015 ICC changed the rule and say that DOCDEX should not be limited to only LC, right? Rather, it can also deal with the broader trade finance dispute. It can also deal with the broader trade finance dispute, right? So there was an update. So after the update, DOCDEX, now cover everything. It cover the trade loan. It cover the risk participation agreement, right? So it cover the trade loan. It cover the risk participation agreement. It's called RPA, right? It cover the risk purchase agreement. it covered the negotiable instrument, right? And it covered the syndicated facility. It covered the syndicated facilities and traditional LC guarantee dispute. So if you dispute include, so if we talk about this particular case, if this case, dispute is regarding what, if this dispute include basically LC plus risk purchase agreement, yes, DOCDEX can handle it, right? So that is what revision has been made in the year 2015. So let me give you of the super simple example. So old DOCDEX say that I only repair car, just an example. And the 2015 DOCDEX says that I repair car, I repair bike, I repair scooters, I repair truck, plus I also repair hybrid vehicle. So that is, risk purchase agreement. RPA is like a bike, right? Earlier not allowed, now allowed under the new rule. That was the difference, right? Now let's look at the options. Option number A say no. DOCDEX is strictly limited to UCP 600. No, that's wrong. Why? Because that was the old version, and this 2015 update, it expanded the scope. And in the recently held examination, we have seen that they are mostly inclined toward asking the question related to the updates. What about option B? Option B says that it must go to the court if multiple instruments exist. Sorry, option number C. Yes, option number B is the correct one. Yes, the 2015 update expanded the scope. Yes, this is the correct one. What about C? C says that you must go to the court, must be settled in a court of law, right? If multiple instruments exist. What do you think about option C? Actually, this is wrong. Option number C is wrong. Why it is wrong? Because DOCDEX explicitly allow complex multi-document dispute, right? It explicitly allow complex multi-document dispute. What about D? Yes, but only if the dispute is valued at after $1 million. What do you think about D? This is also wrong. There is no minimum or there is no maximum value limit in DOCDEX. There is neither minimum nor maximum value limit in the DOCDEX rule, right? So what we learned from this discussion is that DOCDEX 2015 become Doc Connect, right? So you can think of a super easy way to remember it. So this DOCDEX 2015 it becomes Doc Connect, meaning that it connect more trade finance document, not just LC. It connect more trade finance document, right? Not just LC. If you see trade loan, risk purchase participation agreement, DOCDEX 2015 handles all these things, right? So what we learned from this question is that DOCDEX originally was only limited to LC, guarantee, collection, but after 2015 update, trade loan, negotiable instrument, risk purchase agreement, syndications, and traditional LC dispute all are handled. There is no monetary threshold. Multi-document disputes are quite acceptable. Now friends, let's look at the second question. Very good question it is. Let's try to understand what this question is all about. Again, it is related to the DOCDEX. Now what is happening here, once the case file is submitted digitally and the ICC, that is International Center for ADR, appoint the expert panel, what can the parties expect regarding the timeline and the identity of the decision maker? So case file is submitted digitally and ICC appoint ADR, appoint the expert panel. So what can the parties expect regarding the timeline and identity? So the option A says that decision within 90 days. The name of 3 experts are published for transparency. Decision within 30 days. The identity of the expert remain confidential. Decision within 15 days. The parties may interview the expert via the online portal. Decision within 30 days. Only the chairman of the panel is identified to the parties. Very good question it is. Let's understand this is the super simple way. See what happened. So we are talking about DOCDEX. So whenever the DOCDEX case begins, DOCDEX case begins, everything happened digitally. Please understand. Everything happened digitally. So the ICC, ICC Center for ADR, ICC Center for ADR, what it does? So it appoint 3 independent experts. It appoint 3 independent experts to what? To review the case. It appoint 3 independent experts to review the case. Now party usually want to know 2 things. First thing, they want to know how fast is the decision, whether the decision is fast or not. Second thing, they decide who are the expert, right? Who are the expert deciding my case? Right. So basically what we are talking about, whenever the DOCDEX case begin, everything happened digitally. The ICC Center for ADR appoint 3 independent expert to review the case. Now the parties usually want to know two things: how fast is the decision and who are the expert deciding my case. And if you talk about the timelines, so DOCDEX is quite fast. DOCDEX is designed for speed. You know it very well that DOCDEX is designed for speed. It is very fast, right? So the expert must give a written decision. The expert will give a written decision, and within 30 days. Within 30 days, they will give the decision from the date they receive the full case file. Think of it like fast track court. You can think of it like fast track court. No delays, no hearing, no back and forth. 30 days, that is fixed. So that is what we talk about the timeline. Timeline is 30 days. Please note it down. Now the second thing is identity of the expert. Please understand. Identity of expert. What do you think about identity of the expert? So here comes the interesting part. DOCDEX does not reveal the name of the expert. Why? The DOCDEX does not reveal the name of the expert because to prevent any pressure, to avoid influence, right? And to keep the process neutral, right? To protect the expert independence, So the parties do not know who the decision maker are. Only ICC know. Only ICC know that these are the decision maker. That's it. So this ensured zero bias. This ensured zero bias plus full impartiality. Right? So what is the correct answer here? So that is why if you look at the correct answer in this particular case, what can the party expect regarding the timeline and identity of the decision maker? So option number A says that decision in 90 days and the name of the 3 experts are published. No. Completely wrong. DOCDEX is very fast, not slow, and names are never disclosed. What about B? Yes, this is the correct one. Decision within 30 days and identity of the expert remain confidential. Exactly. What about C? Decision within 15 days plus party can interview the expert via the online portal. No, it is completely incorrect. Why? Because expert cannot be contacted or expert cannot be interviewed. Right. And what about option D? A decision within 30 days, only the chairman of the panel is identified to the parties. So no names are ever revealed, not even the chairman. Right. So there is a trick to remember this thing. Let me tell you the trick. So 30 days, just remember 30 days, 3 expert, 30 days, 3 expert, 0 names. So 30 days for decision, 3 expert panel and 0 entries revealed. So DOCDEX is document based, not people based. This way you can also remember it, right? So DOCDEX is all about document based. People identity is not revealed, right? So meaning that it focus on the document, not who review them. So what we learned from this discussion is that it is run by ICC Center for ADR. There's a panel of 3 independent expert. 30 days timeline after the file is received. Everything is fully digital. Expert identity are confidential. See why I'm repeating again and again, so that you understand everything. If any question appears in the upcoming examination, you can answer it confidently, because I have revised the same thing thrice. If you go through the entire video, this is the similar pattern that we are following. We are just not concentrating on the correct answer. We are focusing on what is wrong, why it is wrong, what can be the correct answer, what is the short trick to remember. If you really think that this is helping you, it is adding value to your preparation, please hit that like button and please subscribe the channel. Now friends, let's see the next question. This is again scenario based question. Very good question it is. Let's have a look. So basically what is happening here, Global Tech Solution. Global Tech Solution. It has a Liaison office in Mumbai. It has a Liaison office in Mumbai. It is a company headquartered in Germany, right? It has a Liaison office in Mumbai. You know what happened? Last month it received 50,000 rupees income tax refund. $50,000 I think. No, I think they have mentioned dollar. I think take is INR. Don't take dollar. Right? Remove the dollar. Let me remove it. 50,000 INR from the income tax department. And also they received 20,000 rupees. Just remove the dollar. 20,000 rupees refund for the security deposit. So 2 things they have mentioned: 50,000 refund for income tax and 20,000 refund from security deposit, right? And what they did, they sold 2 old laptop and want to use the money. So basically the LO sold 2 old office laptop right, and want to use the money to pay electricity bill and intend to use the proceed to pay for local staff monthly electricity bill. Now they want to open a second bank account in the Bangalore, right? They want to open a second bank account in the Bangalore without RBI approval, without seeking prior RBI approval. That's it. Now the question is, which of the following is a violation of the prescribed rule? Which of the following transaction taken by Global Tech Liaison Office would be considered a violation of the prescribed rule? Option they have mentioned: crediting the tax refund of 50,000 INR into the account, crediting the 20,000 INR security deposit refund into the account, opening a second bank account in the Bangalore to facilitate local payment, using the sale proceed of the laptop to pay for the office electricity bill. So that's the question, right? So which option do you think is correct? So let's understand this like a story, right? Let me explain it like a story. See what is happening here. There is a liaison office in India. Liaison office in India. So it is like this is like a representative office. You can think of it like, representative office. Okay. It is not allowed to do business. This liaison office, this is not allowed to do business. They are not allowed to do business. Rather, they earn income. What they do? They earn income, right? Bank account is allowed. I told you, if they want a second account, they need to take RBI approval. RBI nod is necessary, right? So in this case, what is happening? This particular Global Tech Bank, they are opening a second bank account in Bangalore without seeking prior RBI. It is a completely violation, right? So what is the option? Which of the following transaction or action taken by Global Tech Liaison Office would be considered a violation? Option A: crediting the tax refund of 50,000 INR into the account, crediting the 20,000 INR security deposit refund into the account, opening a second bank account in the Bangalore, and using the sale proceed of the laptop to pay for office electricity bill. So the correct answer is, if you look at the option number A, so tax refund are permitted credit in the LO account, right? So these refund are not income but return of the excess payment. Actually, these basically refunds, they are the return of the what excess payment. So this is allowed. What about this crediting the 20,000 INR security? Yes, actually, refund of the deposit is also permitted, since it is simply return of the money earlier paid. So yes, it is correct. What about C? They are saying that opening a second bank account, clearly not allowed. Just now I have told you, they cannot open second bank account in Bangalore without taking RBI approval, and that is our correct answer, because the question is, which of the following is a violation? Yes, option C is a violation. What about D? Using the sale proceed of laptop to pay for office electricity bill. So it is allowed, because liaison office can sell old office asset, use proceed to meet the local expense. All these actions fit within the permitted financial operation of the LO. So option number D is also correct. So there is a way to remember it. Just now what we have talked about liaison office. So liaison office means one office, one account. One office, one account. So if you remember just one line, remember this: liaison office is just only one bank account unless RBI say yes, right? So what we learn about liaison office, that they can receive refund, like liaison office can receive refund like tax deposit they can receive. Second thing we have discussed is that LO can also pay the local expense, right? Allowed. They cannot open a second bank account without taking RBI approval. Please note it down. Now the second part of the question regarding the liaison office is, as you can see on your screen. So they are asking you, under the permissible credit rule, which of the following is not an authorized source of fund for the liaison office bank account? Not an authorized source of fund. That's the question. Not. Please, I'm just emphasizing on this word not. Option they have mentioned that remittance received from head office in Germany through normal banking channel. B says that commission earned from an Indian client for facilitating a sales contract. C says refund of a security deposit paid to local utility provider. D says refund of duties paid to the custom authority. So which of the following is not an authorized source of fund for the liaison office bank account? That the question is all about. So let's answer this question. So first of all, before answering it, let's simplify it. So basically, if we talk about the LO, right, let's first of all simplify this particular question. So if we talk about the liaison office, if we talk about the LO, so LO in India is just a representative office. Remember, it is just a representative office. It is like a messenger. It is like messenger, right? Or coordinator. You can call it messenger, you can call it coordinator. Between what? Between the foreign head office and the Indian parties, right? Just representative office. So basically, right, but what it cannot do? Yes, it cannot do something. What are the things? Like it cannot do business. It cannot earn income. So these things they cannot do, right? It cannot provide services for money. It cannot provide services for money, and it cannot generate profit in India. It cannot generate profit in India, right? So what we learn from this discussion is that suppose a LO is there and this LO is earn commission, it is earning fee that become a commercial activity. Suppose this LO is earning fee, right, earn commission or fee that become commercial activity which is strictly prohibited. So if you look at the option number A say, HO remittance through normal banking channel. Remittance received from HO through normal banking channel. Yes, this is allowed because this is the main permitted credit for an LO. All expense must normally be funded only by head office abroad. What about B? Commission earned from Indian client for facilitating a sales contract. So LO is not allowed to earn commission, right? This is wrong. And LO is not allowed to facilitate sales for profit. LO is not allowed to charge service fee. LO is not allowed to do business operation. Anything that result in income become illegal under FEMA rule for LO. So yes, B is the correct answer. Right. So what LO is not allowed? Earn commission, facilitate sale for profit, charge service fee, do business operation. Right. What about option C? Option C says that refund of so not an authorized source of fund. That is what his question is all about. Right. C says refund of security deposit paid to local utility provider. Yeah, this is not income, just the return of the money early paid. This is allowed. And what about D? D says, refund of duty pays to customer authority. This is also allowed because refund from government agencies like customer tax authority, this is a part of the permitted list. So B is completely prohibited, right? So remember, liaison office is not allowed to earn commission. Please remember it. They are not allowed to earn commission. They are not allowed to facilitate sale for profit, charge service fee, do business operation, right? So there is a trick to remember it. Let me write down the trick. LO no income, LO no income, only earning from what? Only earning from HO. If the money comes from India as earning, suppose try to understand that this is India, right? If the money is coming from India as earning, it is illegal. They cannot do that. And if the money comes from head office, it is legal. So refund are fine, revenue is crime. This way you can remember. For LO, refund are fine, but revenue is crime. They cannot earn revenue. Revenue is crime, right? So just now we have what we have discussed. Let me just summarize in just few words that LO can have only one bank account. Main credit is their head office remittance. They are also allowed tax and custom refund. LO cannot earn any income, commission or fees in India. So only the prescribed item is option number B, right? We talked about permissible debit is for local office expense only, right? They cannot earn any commission, fee or profit in India. Now friends, let's have a look at the third question. I think this is the fifth question of today's session. So basically the question is all about Mr. Gurdeep Singh, right, a resident Indian, is planning a day visit to Gurudwara Darbar Sahib in Pakistan via the Kartarpur Sahib corridor. He is aware of the LRS, right? So which you know it very well that he allowed to spend this much. He intends to carry a mix of Indian rupees and US dollar to cover the local offering and a small purchase during their visit. Now the question is, according to the specific RBI guideline for Kartarpur Sahib corridor, what is the maximum aggregate value of the currency note, that is INR and foreign currency combined, that Mr. Singh is permitted to carry physically across the corridor? So how much currency can Mr. Gurdeep physically carry while traveling through the Kartarpur Sahib corridor? Let's break it down in the simplest way possible. So basically what is happening that he want to go to Gurudwara Darbar Sahib Kartarpur using the Kartarpur Sahib corridor. He know about LRS, right, which allow dollar, how much? 2.5 lakh dollar per financial year. But that has nothing to do with how much cash he can physically carry, right? It has nothing to do with cash he can physically carry. The corridor has a special rule. The corridor has a special rule. So what is the general rule for foreign travel? So let me talk about the general rule for foreign travel. Under normal FEMA rule, an Indian traveling abroad can earn 25,000 rupees in INR note, right? Except Nepal and Bhutan. So an Indian traveling abroad can carry 25,000 rupees in INR note. But Kartarpur corridor is not treated like regular foreign travel. So there is a special rule for Kartarpur corridor. So RBI has issued a special restriction that pilgrim can physically carry up to 11,000 total. Right. This include INR note. This include USD note. Right. And any other foreign currency note. So even if Gurdeep carry USD plus INR combined, the total value cannot exceed 11,000 rupees. Why this rule is there? This rule is for maintaining the security. This rule is for regulated movement. This rule is for prevention of misuse, because the visit is only a day trip, no stay, right? That's why the correct answer is 11,000 rupees. That's it, right? Indian rupees plus dollar combined. Okay, so just remember, right? Kartarpur limit is cuts. It less than half, 11,000. Day visit means day budget, just 11,000, right? I hope this is crystal clear right now. Now have a look at the next question. So just now we have discussed that physical cash limit is 25,000 rupees, but for Kartarpur corridor travel 11,000 rupees. LRS annual limit is the same, right? Now very important question based on FTP 2023. This question is based on foreign trade policy which has been recently revised in the year 2023. So revision based questions are frequently asked in the examination. The question is all about that Indo Global Textile. It is a major export house previously relied on direct finance subsidy to maintain its competitive edge in the European market. With the notification of the FTP 2023, the company find that these subsidies are being phased out in the favor of RODTAP scheme. What is the scheme? RODTAP. That is the remission of the duties and tax on the exported product. Simultaneously, the company is encouraged to participate in a new initiative where its home district is developed as an export hub through collaboration between state government and Indian mission abroad. So this is the scenario. Now the question is, Indian global textile shift from direct subsidies to the RODTAP scheme primarily address which objective of the four pillar of the FTP? You know it very well that for FTP 2023 there are four pillars. So there has been shift. Earlier there was a direct subsidies, and now there is a RODTAP scheme. So this shifting from direct subsidies to RODTAP scheme, it address which objective? So the options they have mentioned is that transitioning from ease of doing business to emerging area. Option B, shifting from incentive to remission to ensure compliance with WTO norms. Option C, moving from export promotion to import substitution. Option D, implementing ESCOMAT policy simplification to reduce the cost of textile machinery import. So these are the four options they have mentioned. So let's get started with our first option. So basically let's make it super simple to understand this particular question. Earlier India, what used to do? Earlier India used to support exporter. India used to support exporter by giving direct subsidies, right? And India used to support exporter by giving direct subsidies like MEIS, like SEIS, like other financial incentive. But the World Trade Organization, that is called WTO, right? But the World Trade Organization said that these look like prohibited subsidy. WTO says that just wait a minute. What WTO says? WTO says that this looks like prohibited subsidies. It looks like a prohibited subsidies. Under the SCM agreement, countries can challenge these at WTO court. So what happened in FTP 2023, India changed the strategy, right? So what was the old model? The old model was we give you incentive to export. Old model was that I will give you what? I will give you incentive for what? I will give you incentive for export. That's it, right? What is the new model? The new model says that that we only refund the taxes you already paid, nothing extra. We refund the taxes you paid. That's it. So this refund based system is what we call, this refund based system is what you call RODTEP. That is called remission of duties and taxes on export product. So this ensured that India is fully compliant with the WTO rules. This ensured not giving any illegal subsidies, right? This ensured only returning tax that should not be exported. This ensure only returning tax that should not be imported. So this into rod tape. And the last option they have given, as comet policy simplification. What do you think about it? Basically, as comet deals with controlled item like drones, chemicals, defense goods. They are not textile, subsidies. So, as comet deals with drones, as comet deals with chemicals, right? As comet deals with defense goods. They are not textile subsidies. So what is the correct answer to this question? Correct answer is option number B, right? So basically shifting from incentive to remission to ensure compliance with WTO norm like the SCM agreement. So you can think of rod tape like one way. Let me give you just one trick to remember this rod tape. So rod tape, you can think of refund. You can think of refund, not reward. This way you can remember it. This is the kind of refund, not reward. So if money is a refund, it is a WTO compliant. Refund is WTO compliant, right? If it is a reward, suppose it is a reward or suppose it is an incentive, right? In that particular case, it violate WTO, right? Refund is WTO compliant, reward and incentive will violate WTO. And FTP, this FTP 2023, just remember this line, very, very important. This FTP 2023 is a reward based system. Refund based system. Just wait a minute. It is a refund based system, right? So what we learned from this discussion is that, FTP 2023, correct answer is option number B, right? So FTP 2023 it replaces incentive with remission scheme. Reason is that WTO objected to India's export subsidies under the SCM agreement, and this rod tape refund taxes already paid, not a subsidy. And this was the pillar number 2. Pillar number 2 says from incentive to remission, right? So pillar number 2 says instead of focus on remission from incentive. Now the next question that we have, as you can see here, that the development of the Indo-Global Textile Home District into export hub through partnership with the Indian Mission Abroad is an application of which theoretical basis mentioned in the policy, right? That's the question. So the options they have given is that import substitution theory, comparative advantage theory, B number, C says protectionism theory, and D says fiscal neutrality theory, by ensuring that the state government does not collect any tax from the district. So very good question it is. So what this question is saying, that government is turning certain district into export hub, right? So government is turning some district into what? Export hub, meaning that this district will be known for a specific product that they are naturally good at producing. So this district will be known for a specific product that they are naturally goods for producing. For example, let me give you some example to understand it clearly. For example, one district may be good at textile. Another district may be good at spices. Another district may be good at handicraft, right? So basically Indian mission abroad, our embassy will promote this district product in foreign market. Will promote this district product in the foreign market, right? So district, basically one district may be good at textile, spices, handicraft. So Indian mission abroad will help promote this district product in the foreign market. Now the question is, which economic theory does this idea represent? Yes, this is called comparative advantage theory. Let's understand this in very super simple way. What does it say? That comparative advantage says that do what you are best at and trade the rest. See, it says that do what you are best at and trade the rest. That is what it says. So every region have some natural strength, right? Some places have skilled labor, some places have raw material, right? Some have traditional craft skill, some have climate suitable for certain crop. So if a district uses its natural strength to export more, it grow faster and the country earn more foreign income. So suppose there is a district, right, and that particular district it uses its natural strength to export more, it grows faster and the country earn more foreign income. This is exactly what the policy is doing, identifying each district best product and helping it enter the global market. So the government is not forcing district to make everything. Like in the case of import substitution. What happened in the case of import substitution? Every district is said to import everything, make everything. No, no, no. Rather, the government is encouraging them to focus on what they naturally excel in and sell it globally. So if you look at the option number A, B is the correct one. Option number A is about import substitution. That is about reducing import and being self-reliant internally. Here the goal is exporting, not avoiding import. That's why option number A is wrong. C says, protectionism. Option number C says protectionism. So, protectionism means restricting foreign competition. But this policy promote global integration, right? So please remember, protectionism, whenever I say, it simply means, restricting foreign competition. Foreign competition restricting, right? That is called protectionism. But this policy promote global integration. And the last option we have is called fiscal neutrality. So this is not related. This policy is not about tax neutrality. It's all about, export competitiveness, right? This policy is about, export competitiveness, right? So please understand, fiscal neutrality is not related to it. So how does this fit FTP 2023? So see, let me show you the focus of this. So primary support was, old policy regime was primary support was subsidies. And the FTP 2023 regime, it is duty remission, that is tax refund. WTO issues, often challenged at the WTO, and here it is WTO friendly. The FTP 2023 WTO friendly. Third point is administrative approach. So here it is manual, and here it is, IT based automation, one day processing. And if we talk about the strategy focus, so here we have centralized export, and on the other hand, we have district as export hub. In FTP 2023, we have district as export hub. So I hope this is crystal clear how the old policy differed from the FTP 2023 regime. So just one trick to remember it, right? Let me write it down. So you can use this trick to remember this entire thing. You can think of the district as a strength, right? And a strength means what? A strength means advantage, right? And advantage means what? Comparative advantage. Just link the word district with advantage and you will never forget the answer. So what we learned from this discussion is that, export hub promote district level strength. Indian mission abroad help those products enter global market. This align with the competitive advantage theory. This is not related to the import substitution. Now friends, let's do one more question. And the question is regarding, Mr. Aryan. So what is happening, basically, Mr. Aryan is planning a series of foreign exchange transactions for the financial year 25-26. His planned expenses are as follow: 8 lakh for his daughter self-funded university tuition, 3 lakh for a family medical emergency treatment in Singapore, 11 lakh for a luxury overseas tour package to Switzerland, and 5 lakh as a gift to his sister living in Canada. And he has a valid normal PAN and intend to process all the transactions through his primary PAN. So now the question is, considering the combined threshold, what will be the total TCS deducted on Mr. Aryan combined remittance for the tuition, medical and gift? Very good question. So last time also TCS case study was asked, and this is the revised version. What we are discussing is the revised version. It has been revised in the year 2020-25. So we are just using the concept that we have revised. So basically there are 3 remittance here. What are the remittance? Tuition fee 8 lakh, medical fee 3 lakh and gift 5 lakh. If you add all of them, total is how much? Total is 16 lakh. So now you apply the 10 lakh threshold. Please apply the 10 lakh threshold. Right. So just apply the 10 lakh threshold. So the rule is that, education plus medical plus other purpose, right? So all of them, share a combined threshold of 10 lakh. So this 10 lakh is consumed in the order of transaction. It is consumed in the order of transaction. So now let's look at this particular case. Let's have a look at this particular case. What is happening here? That transaction order is like tuition is for 8 lakh. You can see written here. Tuition is how much? Tuition is 8 lakh. So it comes under the threshold. So no TCS. Right. Threshold left is 2 lakh. Now medical. Now if you look at the medical is how much? 3 lakh. So out of this 3 lakh, 2 lakh fit in the remaining threshold because total threshold is 10 lakh. So out of 10 lakh, 8 lakh has been consumed here. 2 lakh is left. So out of this 3 lakh, 2 lakh is consumed in the remaining threshold, and remaining 1 lakh, crosses the limit, right? Remaining 1 lakh, it crosses the limit crossed. And what is the limit? So TCS at the rate 5%, right? So what is the 5% of 1 lakh? 5% of 1 lakh is 5,000 rupees. Now the question is, why this 5%? You may ask me, why this 5%? Because medical plus education above threshold, they are taxed at the rate 5%. Just remember it. Medical plus education above threshold, they are taxed at the rate 5%. So first of all, we have covered the tuition. Second thing, we have medical. And third thing, we have, a gift, which is 5 lakh. So now let's look at the gift. Now gift is beyond the threshold, right? So just remember, for medical and education, it is 5% beyond the threshold. Gift is obviously 5 lakh is beyond the threshold. And the TCS rate is 20%. So what is 20% of 5 lakh? This is 98,000. No, I think this is wrong, because I think this is not 98 lakh. Just wait a minute. 5% of 1 lakh, just now we have seen, but wait a minute. So 2 lakh, we'll see. Out of 10 lakh, 8 lakh was consumed here. And 1 lakh, yes, 1 lakh limit crossed, TCS 5%, 5,000. And gift, we talk about 5 lakh, 20%. So 20% of 5 lakh is 1 lakh, right? So 1 lakh. So let's do the final calculation. So final calculation is what? Medical access, right? Medical access, gift amount, total TCS is how much? Total TCS is 1 lakh 5,000, right? 1 lakh 5,000 is the correct answer. So 1 lakh 5,000, I think this is the correct answer. So friends, we have some more question available, and that the explanation of the remaining question will be available to our paid member. If you also want to get access to such question, please enroll in our course, right? It is a very effective course. Many aspirants have cracked the examination using the course.